dear financial advisors, you were made for times like these. The times when nothing seems right, and the ones when anything seems possible. Your advice turns potential into reality. It makes dreams come true. And through it all, there's one investment company that's made for you.
Hi, everybody. Alex Sasso here, your host for today. And joining me is Phil Diorio. We're going to be talking about some really exciting themes today, and in particular, how NCM Core Global and NCM Core International mandates will benefit from some of these trends that Phil will refer to. Today is Tuesday, June 11th, 2024. As I mentioned, we're joined by Phil Diorio. He heads the team that manages both the Core Global and the Core International mandates. Phil has his Bachelor of Commerce from the University of Western Ontario, his MBA from the University of Toronto, and of course, Phil is a CFA charter holder, and he put that good education to use as Phil worked with some of our industry's biggest firms. But we're happy to have him in the seat today, specializing, and for the past 20 years, he's specialized in global equities. So we're happy to have him on board. I also wanted to mention to everybody that our website has a lot of really great information and useful tools that you and your clients can take advantage of. So please take a few minutes, navigate the site. We've heard a lot of positive feedback on the content, on the look. Our expert insights section receives a lot of praise. And of course, we have some advisor tools on the site as well. And all of this to say that a replay of the webinar will be posted on the site later on. You should also know that Phil is a regular contributor and author to various topics of interest that we do post on our expert insights section. And I'll just kind of cherry pick a few. In June, he wrote about the Bear Market Initiative. It's a really good read. In February, he wrote about Market Breadth and the Magnificent Seven. Again, a good read. And my favorite is probably his article going back a few in September of last year, just talking about AI hype and whether or not that's leading to a bubble in tech stocks. Again, well worth your time and well worth the read. All right, our disclaimer, but these things are necessary, and just have a quick review of the standard disclaimer that basically says that we don't have a crystal ball, but we're going to do everything we can to populate the portfolios with the very best of the best companies, some of which Phil will refer to later on in the presentation. So welcome, Phil. Really happy to have you here today. And just thinking about the first topic, here in Canada, the economy can only really be described as sluggish. We saw that the Bank of Canada just recently cut rates by 25 basis points. In Europe, we're expecting the same thing as we progress through 2024, but the story is just a little bit different in the US. So maybe start by giving us, given that you have global oversight, maybe start by giving us a synopsis on what you're seeing from a macro perspective, Phil.
Sure. Thanks, Alex, and welcome everyone to the webinar. I don't want to spend too much time on the macro. We are bottom-up investors, but I think it's important to have a macro view. The U.S. would be one of the stronger economies. Europe, China have been weak, but feels like we're getting closer to a bottom there, and with a recovery on the horizon. But when I look at the global economy as a whole, I do believe we're headed for a soft landing, and a few factors, at work here. First and foremost, that the global economy has proven to be a lot more resilient than what people have expected. There have been a lot of recession calls over the last 12 to 18 months, and things have turned out better than what were forecasted. Also, inflation has been moderating in most parts of the world. It's not quite at the 2% threshold that a lot of the central banks would like to see it at, but it's going in the right direction, and that's setting the way for interest rate cuts, which, as Alex mentioned, we already saw that from the Bank of Canada last week. The European Central Bank also cut rates last week, and I think it's just a matter of time before we see the US follow suit. On the next slide, I just wanted to highlight some of the things that we've had to go through in the global economy in the last few years, whether it was COVID, whether we had the wars and all of the disruptions that fell out of those events to all the supply chains and the global energy markets and food markets, and then put on top of that inflation at multi-decade highs and the resulting tightening from central banks around the world. With all of these things happening, you'd expect that we would have already been in a sizable recession, and it hasn't happened. And in fact, when you look at some of the leading financial agencies, the IMF and the OECD, they've actually been increasing their GDP estimates for this year and next year, as you can see on this slide. So, with that said, economy is resilient, and that's why we see a soft landing unfolding.
Yeah, and what's really interesting is that I think your point about falling inflation is key, because a lot of pundits out there believe that the Fed has already benefited from the harvesting of the slowdown that we saw post-COVID. So, watching that 2-year treasury is going to be key, because the 2-year treasury is a leading indicator of what happens with inflation. And, if inflation does come down, then it gives the Fed a license to start with, a bit looser of a monetary policy, i.e. rate cuts, which, obviously the markets have built into their expectations. But maybe just, Phil, if we can just toggle to the next topic here. You don't own unprofitable story stocks. Nobody here at NCM owns those type of businesses. All of our companies have to pass certain quantitative and qualitative tests. Each of our portfolio managers follows a pretty rigorous process of disciplined investing. And I think that's why you see some of the consistency of the numbers amongst products on our product shelf. Maybe take me through the global team's investment philosophy.
If I had to describe our philosophy in one word, I would say quality. Now, that's a term that gets used a lot, and probably means different things to different managers. So I'm going to talk a little bit about, what I mean by quality and what I'm looking for. And you can see here on this chart, there's certain characteristics that we're looking for when we're making investments in companies. And, we like to find companies that are operating in good industry structures where the barriers to entry are high, or what Warren Buffett would call a wide economic moat. And just as important is to have a strong management team, because you can have a really good company and a good industry structure, but if it's not managed properly, then things can get messed up pretty badly. But when you marry up those two criteria, a good company in a good operating structure that's really well managed, after that, those types of companies typically can do well, and they're set up to generate a lot of free cash flow. They can generate high returns on invested capital and high ROEs for long periods of time. And when you're doing that, you're going to be generating lots of cash, and it enables you to keep your balance sheet clean, so that you can keep investing in the underlying business or make acquisitions, and it sets you up to generate stable earnings growth over a multi-year period. I guess after this, I would like to talk a little bit about the investment process. As I said earlier, I didn't want to spend a lot of time on the macro, because we spend most of our time reading and doing lots of research on our companies. And what that allows us to do is have a very concentrated portfolio. If you know your companies well, you've earned the right to take big positions. And so we typically would have 35 to 45 stocks in the portfolio at any given time. And one of the advantages of having a concentrated portfolio and knowing the companies well is when you get into periods of elevated volatility or when you have market drawdowns. When that happens, the babies typically get thrown out with the bathwater. And so, we'll know when we feel that companies are being unjustly punished. And we're seeing big drawdowns in names that we know really well that we don't think should be down as much. And that presents, a great buying opportunity. Risk is a big thing too, managing that risk. I mean, each company has their own business specific risks. So we're monitoring that like everybody else. The next layer of risk is making sure that the reason we bought the stock in the first place is still valid. So, we refer to that as the investment thesis. And we're in a world where things change very rapidly. And we have to make sure that on an ongoing basis, we're always validating the investment thesis for each and every company in the portfolio. And if things change, we have to take action. And I'd like to give an example on this, which with a company that everyone knows, which would be Facebook, as it was called at the time. Back in 2022, we were on an earnings call. And Mark Zuckerberg announced that they were going to pivot the business towards the metaverse and that they were planning to spend over $10 billion in 1 year to build out the metaverse, which to us was something that was new. It was unproven. We didn't like the sound of that at all, and neither did the market. On that day, the stock fell 25%. And we had a lot of meetings. We talked about it, and we actually made the decision to sell the stock that day when it was down 25%. In hindsight, it was a good decision. The stock fell another 60, 70% after we got out. But about a year later, Zuckerberg pivoted again. And all of a sudden, we were hearing good things about cost control, the year of cost efficiency, de-emphasis of the metaverse. And we actually got back into the stock at a price that was 25% lower than where we had sold it, without having all the baggage of riding the thing down. So that was good. That's an example of not being stubborn. And when things change, we need to change along with it. Valuations are also part of our risk controls. We use discounted cash flows to value all of our companies. And, we're always monitoring how our stocks trade relative to our estimate of the intrinsic value of the business. And, it's our job when things get overdone to trim and sometimes eliminate positions. Finally, the investment horizon, we do look out 4 to 5 years. We think long term, and we think it's important. It helps us, I guess, get away from some of the noise that can happen in the market and making sure we don't start thinking in too short term of a time horizon. A good example of this would be during COVID. In March of 2020, there was a lot of uncertainty as COVID started to unfold, and the S&P 500 fell by close to 35% in a 1 month period. If we were too short-term focused, we probably would have thought it'd be a good idea to just sell and raise cash in light of all the uncertainty. And, as it turns out, that would have been a really big mistake because the market rallied very hard after that drawdown when market participants realized that this wasn't going to be a big plague with billions of people on the planet being wiped out. So keeping that long-term investment horizon very, very important for us. We are running a global portfolio, so we can go anywhere with this fund, which is great. We can go to Europe. We can go to the emerging markets. We can go to the US, where we have a lot of our investments, Japan, and other areas. So how do we whittle down the universe of stocks? So what we developed internally is a proprietary quantitative screen, and there are two key metrics that we screen on: return on equity, which has to be 15%, and the return on invested capital, which has to be 10%. It lines up with our quality bias that we talked about earlier. And by applying these measures along with a frequency that these hurdle rates have to be met, we can narrow down that universe from tens of thousands of stocks down to a universe of 1,200 stocks approximately. And then from there, we whittle it down further to what we call our global best of breed stocks, which is a list of 100 stocks around the world. And then it's from that list that we build the portfolio of 35 to 45 stocks. So that just gives you a sense of our process and how we actually pick the stocks that make it into the portfolio.
Bill, I don't know if you remember, but a few years ago, we had analysts coming into the boardroom pitching us on the metaverse and why the metaverse was the next big thing and how we should be buying real estate on the metaverse. But there was 3D TV, there was other technologies that were supposed to be the next big thing. But that's the reason why our disciplined investment process makes sense, because it prevents us from getting into companies that are non-profitable. That discipline keeps us from some of those things that just turn out to be torpedoes. And in the investment world, we have to make sure that we don't have torpedoes, because we're going to hit some singles, we're going to hit some doubles, we're going to hit the odd home run. But the investment philosophy is one layer of our investment decision making process. But when you dig into the numbers, there's another level of, let's call it, investment assistance that helps nudge us from one company to another company. And we often own these companies before the investment community even realizes that that there's potential in their CapEx investments. And of course, many of these companies are newsworthy today, but when you first got into them, maybe they weren't newsworthy. Could you take us through some of the trends that you see in some of your portfolio companies and some of the mega trends that you're seeing that are impacting certain stocks and certain segments of the market?
I guess one thing I wanted to point out before we dig into this, and it goes back to what you were saying about the metaverse. Some of these themes come and go. Sometimes they're just the flavor of the day, and then they kind of go away. So not every stock we own has to fit a theme. Like, we're not building the portfolio around these themes. More often than not, it's our investment process, which we just described, investing in the good companies that are managed by good people. And those management teams are investing in these exciting areas. And so it's by default that you end up getting exposure to these megatrends. And there are companies in the portfolio, Costco, Walmart, they're not going to fit into any of the trends that we're going to talk about today. And they're just good companies, very well managed. Yeah, with that, I think we should talk about these trends. And I guess the first one that I wanted to talk about is the environment. And there's a lot of different terms that we can use here: electrification, energy transition, decarbonization, all use them interchangeably. What it really comes down to are the global initiatives that a lot of governments and companies are undertaking to make it a greener planet for all of us. When we talk about electrification, we're talking about technologies that use dirty sources of energy, the fossil fuels, the coals, the oils, and then replacing them with friendlier technologies. Now, there are certain sectors that create more of these emissions, and three that are important and that are being targeted would include transportation, and then buildings, including residential and commercial, as well as the industrial sector. And those three sectors account for more than 60% of all the US greenhouse gas emissions that are in the environment today. So that's why they're a focus. Wanted to talk a little bit about how we're going to play this theme. On the next slide, we've got a couple of companies that we own in our portfolios, which would be Schneider Electric and Eaton Corp. And I guess what's exciting about this theme is that it's been estimated that about 70% of the carbon emissions out there today can actually be removed by using existing technologies that are already on the market. And so Eaton and Schneider Electric manufacture a very wide range of products that can help accomplish this. And they have a lot of different products. I mean, one that I'll talk about here is a lot of the products that they have to help retrofit commercial buildings. And so a lot of the solutions they have will optimize the heating, the cooling, the ventilation, the lighting. A lot of the products that they have can be found in a lot of these data centers that are being built everywhere. A lot of the energy efficiency and the cooling technologies come from Eaton and Schneider. And they've done studies on this saying that, carbon emissions can be reduced by about 42% with a payback of about 3 years by implementing a lot of these products. Outside of commercial buildings, there's a lot of other industries and areas where Schneider and Eaton are supplying products, electric vehicles, heat pumps, smart grids, renewable technology. These are all, different areas that these companies are participating in. Staying with the same theme, and on the next slide, we'll move to sort of another area, the industrial gas sector, something that kind of I view as a bit boring on the surface, but these companies they play a very crucial role in the global economy. So Air L'iquide, Linde, two companies that we own, and what they basically do is they provide a bunch of industrial gases, nitrogen, hydrogen, oxygen, and helium. And these gases are essential in the manufacturing of a very wide range of important industries: oil and gas, steel, pharmaceuticals, food, electronics, semiconductors. They go into a lot of different areas. And I guess what's interesting about this particular industry is what's happening with hydrogen, because hydrogen can be used and is being used, as part of this broader initiative to reduce emissions. Right now, most of the hydrogen is produced from natural gas, and that's called gray hydrogen. Now, if you take that and you combine it with carbon capture technologies so that the carbon dioxide doesn't actually get released into the atmosphere, that's called blue hydrogen. And then the most environmentally friendly type of hydrogen is green hydrogen, which is produced using energy from water molecules, and then that's broken apart through electrolysis into hydrogen and oxygen. And it's very, very early days, but it's an area of growth. A lot of investments are being made into green hydrogen, and it's a market that's expected to grow from just a few million today to over $100 billion by 2030. And both these companies profiled here, Air Liquide and Linde, are at the forefront of green hydrogen, and they're making a lot of investments there. And we're pretty excited about that opportunity down the road. So moving on now on the next slide, just want to talk about aging demographics and some of the opportunities that will represent for the healthcare sector. Around the world, every country, there's more and more people getting into their 60s. Last year, or 2022, it was estimated that 10% of the world's population was 65 or older. And by 2050, 16% will be at that age or older. by the end of the century, 1 in 4, 25% of the world's population will be over 65 years old. If we just go to the next slide, I guess another way to just look at this, it's just looking at a little play on the numbers. Back in 2017, there was 1 billion people over the age of 60, and then that'll double by 2050, and then triple by the end of the century, when more than 3 billion people will be over this age. And so why the emphasis on age 60 and 65? And the reason is that there have been a lot of studies done, that just show that the consumption of prescription medicine, medical devices, and healthcare services, it grows exponentially once people hit that age of 60 to 65. And so it's going to open up a lot of opportunities for certain companies in the healthcare industry. And I was going to profile a couple of those companies. So on the next slide, we're going to talk here about ThermoFisher and then Novo Nordisk after that. And so ThermoFisher is a leader in the life sciences industry. They provide a lot of products and services to the pharma and the biotech industry, but also to academic research and government and hospitals as well. What I really like about ThermoFisher, it's not dependent on one technology or one drug or one therapeutic area in pharma. They basically provide a very, very wide range of products. They're the arms dealer, the picks and shovels provider. So they provide lab instruments and tools and reagents, and they provide clinical services, the phase 1 and phase 2 and phase 3 trial services. They have commercialization services. So once you pass phase 3, they're helping the companies get approval from the FDA. So it's a really, really important company, very steady growth, well managed, and we're excited about them. It's a way to invest in the advancement in medicine and healthcare in the years and the decades ahead. Next is Novo Nordisk, global leader in diabetes care. They're a pioneer in diabetes treatment. They have a history that goes back about 100 years. And diabetes is prevalent today, and it's expected to become a lot bigger in the decades ahead because we've got an overweight society in the Western world, and as I just talked about, an aging population. And we're excited about the prospects for Novo Nordisk. It's a very good industry structure, something I talked about earlier. There's really 2 big players here. You got Novo Nordisk and Eli Lilly, and then they dominate the diabetes market. So that's exciting. Beyond that, there's been a bit of a new breakthrough in weight loss drugs. And this is something that was just approved back in 2022 for Novo Nordisk with the Wegovy drug. And the analysts are seeing really big growth for the weight loss industry. And some of the estimates are well over $100 billion in sales by 2030. So it's pretty exciting. And it even goes beyond weight loss. Some people are calling these miracle drugs because they've actually just completed some studies showing that the same molecule responsible for these drugs are able to reduce cardiovascular risk in a very big way. And then there's additional studies beyond that being done right now for treatment of acute kidney disease as well as Alzheimer's. So it's just it's a very exciting area and an exciting time for Novo Nordisk. So we really like that. So let's move on now to Asia, where there's been a real proliferation in wealth. And here is a slide showing how many millionaires there are in the world and the actual growth in the number of millionaires in Asia, which is actually expected to more than double from 30 million back in 2022 to more than 76 million millionaires in Asia. And when I think of Asia, I always think of China. They're a big part of that, but it goes well beyond China. There's a lot of other countries where this same phenomenon is happening, whether it's Singapore, Malaysia, Indonesia, Philippines. It's happening everywhere. And so, how are we benefiting from this? We have a company in the portfolio that we've held for a very long time, LVMH, or Louis Vuitton, as it's known. A company that's been around for over 100 years, and they have some of the best trophy brands, which you can see on the next slide. Whether it's the name of the company itself, LV, Christian Dior, Bulgari, Givenchy, Fendi, Tag, Sephora. They have one of the best collection of brands in the luxury industry. And they have a lot of competitive advantages. This is a very large company, 80 billion euros in annual sales, and they're able to use that scale to their advantage by investing behind the brands. They control their own distribution, and the legacy of the brands in many cases extends for well over 100 years. So you can't just go out and create a new luxury brand from scratch. You can. It's just hard to scale it up to the extent that these brands enjoy. So it's a really good, strong company. They've been very well managed organically and by acquisition, and they've developed this on a global scale. And it's actually a company. It's a little bit out of favor right now because China's gone through a slowdown. Again, thinking about a long-term investment horizon, we really like what the future has in store for LVMH. And then so next, I believe I've saved the best for last. There's a lot of excitement around artificial intelligence, so I thought I'd leave AI for last. A lot of questions about whether the hype is for real. Seeing what's happened with Nvidia and the Mag 7. I don't think we can answer the question today, is the hype for real? I think it's going to take a lot of years for this to play out. But certainly when you look at some of the numbers that are being thrown out there, it would lead me to believe that there's a lot of substance behind this theme. A lot of the consultants out there have written lots of white papers and research reports. PricewaterhouseCoopers has written a piece saying that AI could contribute close to $16 trillion to the global economy by 2030, which is just it's a staggering number. One of the things that I find interesting is when we talk about AI and when we read about AI, it's always about technology. But I think when you sort of peel back the onion, it's going to have an impact on a very wide range of industries, well beyond technology. And in fact, in this same PricewaterhouseCoopers report that I referenced, they talked about retail, financial services, and healthcare as being some of the biggest beneficiaries of AI. So I think it's just going to have an impact on every industry sector. And I guess one of the keys with AI is that it's going to transform the way that everybody works. And it's been estimated that 60 to 70% of the daily tasks that people do can be automated with the help of AI. So that's it's revolutionary to have such a high percentage of tasks automated. And I think for me, one of the things that I'm most excited about is what it will mean for productivity of the global economy. I think there's potential for this to be what we saw in the mid-90s when there was a massive productivity boom on the back of what happened with computers and the internet. And for me, that's where I see a really big promise. So we own a lot of companies in our portfolio that are benefiting from AI and that will continue to benefit from AI. The semiconductors and Nvidia especially get a lot of hype out there. And we own some semiconductor companies that are doing well. I thought I would profile Microsoft because I just see it as a very obvious beneficiary for AI. Starting off with their 49% stake in OpenAI, which is one of the largest AI or artificial intelligence organizations out there. They're the creators of ChatGPT, which was launched in 2022. Beyond that, Microsoft has their cloud business, Azure, which I think is going to be a beneficiary of AI, where their customers can get access to AI's foundational models, or they can use the AI IT infrastructure to run their own models. Copilot being another AI lever, a lot of different tools in there which allow you to draft or create memos, respond to an email. You can create PowerPoint presentations using material that you've already got. So there's a lot of different products that Microsoft has that I think are going to be very big beneficiaries of AI. So we like Microsoft. And so what I thought I would do next is just wrap up the discussion, taking all of the themes together. We do see a lot of runway of growth and think it's going to play out over a very multi-year period. And so we're excited about the thematics. And I just wanted to highlight something that I did say earlier, that we don't just build a portfolio based on themes. We own stocks like Costco and Walmart that don't fit the themes. They're just great companies. They're well managed. They have strong positions. We just bring it back to basics. I kind of talked at the beginning about how we build the portfolios, what we're looking for in the stocks. And so when you invest in a good company and a good structure that's well managed, one of the byproducts of that is that you have these management teams that have the foresight to invest the cash flow in these exciting areas. And then by extension of that, you end up having these companies that are in the highlights today, and they're benefiting from the themes. It's another way of saying that we didn't buy Eaton and Schneider for the green hydrogen opportunity. We didn't buy Novo Nordisk for the weight loss opportunity. We didn't know about that 5 years ago, and we didn't buy Microsoft for AI. We weren't talking about AI 5 years ago, but it's because of our process, investing in good businesses, good management teams. You end up with these exposures, and feel good about that. And that's the end of the formal presentation, and would be very happy to take questions on any of this or anything else that's on your mind.
Awesome, Phil. That is really interesting. Particularly love the themes that you talked about, and it was of interest to me. I read a Morgan Stanley report recently that I'll do my best to explain this. What they did is they took a look at how long it took for a new technology to penetrate U.S. households. So they were looking at, when does 50% adoption happen for new technologies or eras in new technologies? And what they found was, with each new major technology, the time it took to penetrate U.S. households, i.e. that 50% threshold, halved. So they started with the Industrial Revolution. And when did the Industrial Revolution benefit 50% of U.S. households? And how long did that take? And that took 42 years, so quite a long time. And then they took a look at the PC revolution, and that took 20 years to penetrate 50% of U.S. homes. The internet took 12 years. I know that sounds like a long time, and we probably think it took less time than that, but it was 12 years before half of the U.S. population had access to a desktop internet. And it was only 6 years for the mobile phone, internet on the mobile phone, to penetrate 50% of U.S. households. So you can see in each of these revolutions that the time it took to penetrate consumer, the consumer spend was down by 50%. Now we've got AI. And so if you just take that rule of thumb, are we going to see AI penetrate and be of use to U.S. households, a majority of U.S. households, in 3-4 years? And what I can tell you is that, in the companies, in the meetings that I sit in with, it's now almost a question in every conversation with management team. How's AI going to affect your business? What are the risks? What are the opportunities? And what are you doing to prepare for it? Those are all very, very important questions. And certainly AI is a megatrend that everybody on this call or this webinar is interested in. And I know it's very early days and it's hard to know what companies will benefit from AI, but my perception is that there's not a plethora of companies out there that do benefit. And obviously Nvidia is the poster child of this AI trend. Maybe just your thoughts on Nvidia, because I know I get that question a lot.
Yeah, I mean, Nvidia is right now, it would be the poster child for benefiting from AI. Their chips are in very, very high demand, and stock has been a fantastic performer. We don't own Nvidia. It's going to be one of those names that we've been watching for a long time and just never did pull the trigger on it. But we do have other semiconductor companies that we own that have done well. One based in the US called Applied Materials, and another one based in Netherlands called ASML. And both companies are, what I would call similar to ThermoFisher in that they're the arms dealer. They're providing the semi-cap equipment. So they're not relying on one particular niche area to do really well. They're just going to benefit as the entire semiconductor industry benefits. And the thing about semis, we're talking about AI here, which is a really big boom for the semi chip industry. But there's also something else going on because of all the geopolitical factors, that came out of the war, I guess back in 2022, Russia, Ukraine, and then what's happened in the Middle East and other parts of the world. There is a really big initiative right now for semiconductor companies to relocate into geopolitically safer areas of the world. And so that's yet another, positive for the companies like Applied Materials and ASML that are, basically the arms dealer providing the semi-cap equipment.
And let's not forget, the U.S. government is spending $800 billion vis-a-vis the CHIPS Act to onshore a lot of these really crucially important technologies and technology companies. So it's interesting. And speaking of that, Phil, you think about the last 100 years, equity returns have been dominated by what we call the compounders. And you and I throw that word around in our portfolio manager meetings quite a bit. But if you think of the Nifty 50 during that time period and the J's and the J's, the Exxon Mobiles, a couple decades ago, the Mag 7 today, you definitely want to own those companies during those periods of time. But how does Phil Diorio try to differentiate between a Nortel and a Google? How does a Phil Diorio try to differentiate between a US Steel and an Apple? And how do you prevent WorldComs from getting in the portfolio?
Well, I mean, there's a few things there. I mean, it's a really good question. The proprietary screen that we talked about earlier, that in itself will keep us away from non-profitable companies or even low profit companies. That's sort of our, one of our guardrails that sort of gets us going in the right direction. But it's definitely not going to guarantee that you stay away, from other companies. And like you mentioned some good examples. There have been a lot of companies over time that were dominant blue chip, best of breed companies, and then things change and they fall by the wayside. And a couple of good examples would be Intel, Cisco, IBM. I mean, these were the champions of their time, and for one reason or another, things changed on them. And for myself personally, one thing that I try to do is never fall in love with a company because things can change. And that example I gave with Facebook is, a very good example. Things changed materially. Our investment thesis was no longer valid, and we bit the bullet and sold it. And sometimes that's what you have to do. And I think what can help to make sure that we're really good in this process, because it is an ongoing process, is only having 35 to 45 companies. Because if you're constantly validating the investment thesis and you own 100 or 200 stocks, it's harder to keep tabs on each and every company. So that's how I approach it.
Yeah, and I've noticed over the years you're really good at selling companies quickly as soon as the your investment thesis changes on that company, or you find something that is more enticing, and obviously you try to upgrade whenever you can upgrade. I found your discussion on the rising wealth of Asia of particular interest. Now, if I think of Chinese GDP, according to, ever since they joined the WTO, is up 1,000%. It's been phenomenal. It's had massive growth. And yet over that time period, the Chinese stock market hasn't really performed nearly that well. And if I think of US GDP, it's grown, it's done really well, but it hasn't done as well. It doesn't show the same level of numbers as we saw on the Chinese side, yet the stock market has appreciated more in the US. Any insights as to why we're seeing this phenomenon?
I think one thing that really comes to mind that's very important is rule of law, and also the trustworthiness of the accounting and the corporate governance behind each and every company. And the rule of law isn't as strong over there, and the corporate governance and the accounting isn't as strong, and people don't trust it as much. And we had a strange thing happen a few years ago when the founder and CEO of Alibaba all of a sudden just went missing and disappeared from the public for a long period of time. And so I think it all comes down to how much risk do you want to take in your portfolio. And there are a lot of good companies based in Europe and based in the US that have big footholds in China and other emerging markets. And my bias has been to gravitate towards those companies to get exposure to China, and that's LVMH, which is based in France, where I have a very strong view of the rule of law and the corporate governance and the accounting of companies based in France. So that's my way of thinking about it, and yeah.
Yeah, no, good point. I remember Sino-Forest. Us Canadians will remember Sino-Forest very well. So we've seen a massive compression of multiples over there because of that what you just talked about. But switching gears, let's talk about LVMH for a while. It kind of plays into that same theme of growing wealth in Asia. Maybe just talk about that stock. Are you adding? Are you reducing? What do you see for the future of that company?
Yeah, I mean, this is a name that we've owned for a very long time, and the weight had become pretty big in our portfolio. So we actually trimmed it about a year ago, reduced the size of the position, and part of it was the weight, but part of it also was just that there was this slowdown going on in China, and their economy has been weak for a while. There was a lot of hype when they reopened their economy after COVID, because there were 2 years of rolling lockdowns where large portions of the economy were closed, and it kind of fizzled out. And so really like the company, right-sized the position, and as I said earlier, we look out 4 to 5 years. I'm really not good at trying to make forecasts of what might happen in the next 3 to 6 months. So continue to feel very good about LVMH on a long-term investment horizon.
So Phil, we've only got a few more minutes. We've gone well past our allotted timeline. We have quite a few questions that have come in. So thank you, everybody. We're not going to be able to get to all your questions, but what I will say is we'll do our best to reach out to you and help answer some of those questions. One of the questions is, AI valuations, and if you think AI valuations are out of line.
So, I mean, it would vary by company. There are some quasi-tech startups that, much smaller in market cap size that, wouldn't make it through our quant screen process. So we don't really look at those types of companies, but I'm sure there's a lot of them that, are very, very, very expensive because they're not making a lot of money. So it would artificially inflate the PEs and make them look extremely expensive. Our strategy is really more focused on mature technology companies, and the valuations in some cases are a little bit on the higher side, but we're also talking about companies that are growing their earnings 15 to 20%. The ones that we own, we're very comfortable that the higher valuations are justified by the earnings growth. But there are other ones that we own, like an Alphabet, which trades almost the same as the market with a lot faster growth. So it just depends on where you're looking. We're very comfortable with the companies that we own in terms of their value.
Yeah, a lot faster growth, a bit more diversified, and a lot of these AI companies don't have $1 of revenues yet, let alone $1 of earnings. So yes, I would agree. Some of the valuations are out of line. And again, I hate to beat up this point, but we don't own story stocks or unprofitable companies. It's really important for us to have a financial discipline in the investment making process. Maybe just a housekeeping question, because I've got sort of two versions of this in the questions here. Just very quickly, Phil, the difference between Core International and Core Global.
Yeah, and the primary difference is the U.S. So the Core Global is, we can have as much as we want in the U.S. and the U.S. is actually about 70% of the benchmark for the Core Global. So we like the U.S. a lot. The difference with the Core International is that it's everything outside of Canada, the U.S., and Mexico. And the international, also known as the EFI index. So we're basically investing in companies outside of the U.S. and Canada. And so Europe, Japan would be the lion's share of our investments there.
Right. Okay. And then, you touched on risk earlier, and maybe just cherry picking a question here about risk. We're seeing sanctions in China gaining momentum, not just from the U.S., but also from Europe now as well. And perhaps that's going to accelerate reshoring or nearshoring trends that we've been talking quite a bit about. From your perspective, given that you're a global guy, how do you think about geopolitical risks when investing in, like, say, you have a really exciting business, but that it's in a difficult or a risky jurisdiction?
Yeah, I mean, my core philosophy is just to stick, to the companies that are in the safer market. So, the VAT, like almost all of our investments are in Europe, U.S., and Japan. And geopolitics, they've actually become a bigger phenomenon in recent times, in the recent years. And we've looked at a lot of studies going back 60 or 70 years. What tends to happen is you get a knee-jerk reaction after the geopolitical events, but they actually tend to be short-lived. The markets tend to recover in a pretty decent amount of time, and then eventually go on to make new highs. So, not too concerned about the geopolitical reactions in the market. And then from a risk management perspective, we're largely sticking to parts of the world where we feel very good about the rule of law, about corporate governance, and about the accounting of the companies.
Awesome. You've been fantastic, Phil. We're at the top of the hour. There's one question that I see here that I think it's important for us to tackle. I'll do my best to tackle it. And is there a better entry point over the next few years? And, from my experience, managing money for well over 20 years and trying to buy stocks and trying to time the market, it's phenomenally difficult to do so. I would tell you I'm not a good trader. And in my years in the business, I've never met a good trader. And I know most of the traders on Bay Street. I've never met a consistently good trader. All of this to say, buy by time, don't buy by event. So my recommendation, if you're thinking about buying one of these two products, and you're worried about timing, spread it out over a period of time. I'll give you an example. When I buy a new position in a company, I get what I call a starter pack. So I'll get, for example, a 2% position in ABC Corp. And then over the next 3 or 4 months, particularly if it weakens, I'll add to that position. And then 3 to 4 months later, I'll add to that position until I get to my target weight. And sometimes the stock weakens and I get a better buying opportunity. Now, sometimes obviously the stock does well, and that'll play into my valuation calculation. But if it doesn't really take off, then I'll add to it. And if it really does take off, it'll get me to my target weight sooner anyways. So all of this to say that you can spread out your purchases over a period of time, but these are two really interesting mandates that have great quantitative characteristics with it. So Phil, appreciate all the time and effort you put into this, and everybody for listening. We're through the top of the hour here, so I'm going to cut things off. If you have any further questions, please send us a message at sales@ncminvestments.com. Thank you, everybody. Really appreciate your time today.
Thank you.